These are the top 3 mistakes to avoid when raising capital for multifamily syndication deals. Mistake 1, raising money only when you have a deal. Always be raising. We just had another conversation about this in our multifamily mastermind. Always be raising, but like, what does that mean? How are you deemed someone who is always raising? Well, if you get access to a great deal, but you haven't been actively letting people know what you're up to and that you help investors achieve incredible returns, you might find yourself scrambling to just get your deal funded, right? So it takes time for people to get to know you, get to like you, and get to trust you. And the best way to do that is to be present on social media, share with others what you're up to, and never be afraid to let people know exactly what you're doing as an investor and what you're looking for and how you could help people and how you serve people. You'd be surprised how many people in your immediate network are looking to invest in a deal like the one you have or the one that is going to be available. It's an opportunity you'll be offering soon. But they're just unfamiliar with what syndication is or how it works. Be the one to reach out to people and educate them. And when you have an investment opportunity, you've already established yourself as a multifamily investor and started building and nurturing that relationship. So raising capital will be much smoother. And mistake number 2, raising only the amount of money needed to close the deal. So let's say your deal is for a multifamily property listed at $5 million and your team has secured a commercial loan at 75% LTV or loan to value. That means that loan is going to cover $3.75 million, and that leaves you with having to raise just $1.25 million, right? That's all you need, right? So in essence, that might be enough to close, but you must always consider this. Some of the investors who expressed interest gave you a verbal commitment or even a soft commitment in your syndication software online portal will end up backing out. Some of them will. We use InvestNext, by the way. Getting those verbal and soft commitments are crucial, but once you send wiring instructions to your investors and send a deadline for them to wire funds, some are going to be real players and some may end up ghosting you. So over raising and having an excess, usually between 20 to 40%, will help weather any kind of physical or proverbial storm. So like, think about it. What about deferred maintenance and planned renovations and other projects that pop up that might be unexpected? Here's the key, like, you must expect them. Nothing should be considered totally unexpected, but we get better at identifying those patterns with the more experience that we have. To mistake number 3, not knowing the local laws and ordinance. So look, before we move along, I have to take a second to plug this free webinar. Well, I will be live this Thursday. Please comment below if you need help with anything and you're trying to get access to this masterclass. Back to mistake number 3, not knowing the local laws and ordinance. Bottom line up front, there are laws you will need to know and understand so you can comply with them. Here are just a few. When you syndicate a property, you form an LLC or a limited liability corporation. And then when creating a syndication, you'll sell those shares of the LLC that owns and controls title. Because you're selling those shares in exchange for doing some kind of work, effectively, those shares are now considered securities. Here is another thing you must understand. There are 2 types of investors, accredited investors and non-accredited investors. Non-accredited investors can participate as a limited partner or a silent partner if they're considered sophisticated. Now, based on the SEC's Regulation D or Reg D Rule 506B, investors are considered sophisticated if they, number 1, have experience in financial and business matters, or they have participated as a GP or general partner or a JV joint venture in another project similar in size and work involved. They've worked in this asset class or strategy to some capacity, or anything that enables them to not just understand the deal and the offering, but confidently evaluate the risk of the offering or investment. So now think about it. You as the sponsor or general partner in the syndication do inherit more risk with a 506B when compared to a 506C. You'll also be required to have a pre-existing relationship with each investor for that 506B. So extended family, immediate family, or friends, people who already know, trust, and like you. So one of our students that turned into a ADPI Military Multifamily Academy hero, who's now instructing the new cohort classes, Tom Groves, he remembers 506B because you can correlate those investors to being your bros. Reg D, 506B for bros. You know, it's funny. So as opposed to Regulation D, 506C as in Charlie, these offerings are only available to accredited investors and who will need to prove their net worth and their gross income, usually to a verification process or a CPA or an attorney that could write a letter, put their license on the line and say, I have verified this investor's accreditation status. Up to 35 accredited investors could still invest in the Reg D 506B for non-accredited investors, but only up to 35 accredited investors can invest in a Reg D 506B. 506C is for accredited investors only. Now, just because you made it to the closing table and you raise some capital and you close and you have done your part in this deal, it doesn't mean that your job as a capital raiser is done. Your job just kind of got started because nurturing the investors with monthly email updates that correspond with their quarterly distributions, if applicable, is necessary. So this one thing eliminates so much time and energy in the form of phone calls after phone calls. So the relationship that you continue to build with your investors can mean they are the first to get a glimpse at maybe future opportunities. And some investors, just know this, some investors will continue to invest with you over the long haul, over multiple deals. Some won't ever respond to emails or calls, like the investors that nobody can get a hold of, even when you're trying to send them their distributions and their money. And you'll get investors that fall everywhere in between. But automating this process is going to be huge through an email marketing campaign. That is for another video. But look, if you thought this was valuable, I'm going live this Thursday. So I highly encourage you to watch the free masterclass where I'll be live, where I'm going to reveal 3 secrets. It's just 3 secrets that took me a while to just break through and discover and get traction with multifamily investing. Number 1, how to analyze these types of assets. Number 2, how to raise capital for these types of assets. And number 3, how to structure a rockstar team to help you close on these mobile home parks, apartment complexes, storage facilities, so you don't have to waste every waking hour trying to do it yourself. So click the link below and get access to that live webinar where I will be there, and you'll get a ton of bonuses that go along with it. And until then, just keep crushing it. Hope to see you at the live webinar. I'll talk to y'all later.